The emerging world has been home to some of the most troubling virus-related experiences, but also some of the most successful responses anywhere in the world. China and many other countries in Asia, for example Thailand, have had remarkable successes, and yet others, notably in Latin America, continue to struggle. We assess each country based on 3 cycles: the liquidity cycle, the business cycle, and the political cycle. While the liquidity and the business cycles have turned positive, we are most focused on the political cycle, not just in emerging markets, but developed markets also. It will be very important to understand the political knock-on effects ranging from major changes in governments. Think about Argentina last year, to also the potential use of sanctions against countries like Russia and Brazil's ability to impose long-term fiscal discipline. At PIMCO, we are fortunate to have an extremely well-resourced emerging markets team, as well as firm-wide expertise on global monetary and political matters. This means that we can thoroughly cover each and every country across the full opportunity set. And this allows us to stay well-diversified, rather than concentrating into a small subset of countries. Diversification will now be more important than ever. The vast majority of these countries are in sound economic shape and offer attractive levels of compensation, especially considering how low interest rates are in the developed world. But there are a few lower quality countries that remain at the mercy of commodity prices, the IMF, and China's willingness to extend bilateral loans, all of which are difficult, if not impossible, to predict. For the time being, we are emphasizing high-quality borrowers in US dollars until the global economic recovery matures and broadens. Consider Mexico as a case study. While growth there has deteriorated, Mexico's balance sheet remains strong. The question here is not about the risk of capital impairment, but about fine-tuning one's forecasts of inflation. It has been quite sticky and refusing to decline as the central bank would have hoped, and whether or not one should take exposure via dollar-denominated bonds or indeed local peso bonds, and indeed where on the yield curve to be focused. And despite ongoing struggles with the virus in the region, we find that a number of banks and other financial institutions across Latin America, including Mexico and Brazil, are offering very attractive levels of compensation, especially when we consider their leverage and their capitalization. Investors are facing a magnified challenge in meeting return objectives now that yields are so low across the developed world. They need to think through portfolio construction more holistically and consider moving beyond home biases of developed markets, in an effort not just to augment yield, but to enhance diversification. One area that's very interesting, at least for those investors that can move beyond daily liquidity vehicles, are privately originated lending arrangements. Premiums there are incredibly attractive. Private credit in emerging markets is not just about distressed lending. It's about finding creditworthy borrowers that are an important part of the growth cycle and who want to diversify the supply of their capital away from global bond markets. Most EM investors crowd into a tiny corner of the liquid bond market, but there is so much more that is available, and often with far more attractive risk-reward profiles. The most important question EM investors face is the direction of the US dollar. After nearly a decade of appreciation, it's reasonable to ask how much longer this can last, especially given the Fed's drive to keep monetary conditions loose. A turn in the dollar cycle will have major implications for all asset classes, but none more so than emerging market currencies. Local currency emerging market debt already offers yields close to 5%. An additional layer of capital gains on the back of currency appreciation against the dollar would offer investors an attractive opportunity while also diversifying one's overall portfolio.